Welcome to the Portfolio Builder Premium webinar. We're going to cover our strategies, returns, asset allocation, and a whole lot more. Currently, the high risk, high return portfolio is up 310% year to date, outperforming the S&P 500 11 times. If you're on a free trial, this is the strategy you get during your 2-week free trial, but we do have 4 total strategies. And so, excuse me, the high risk portfolio is down 1.6% in November, not 16. I forgot to get the decimal in there. It was up as much as 6%. We had a little bit of a crypto sell-off yesterday. I'll cover what's going on with that. The Buffett strategy, which is a US-centric portfolio that's heavy in growth and value, up 5% in November, called the Safe Alpha portfolio. The Ray Dalio Global Strategy is up 3% in November. That's our most conservative, highly diversified strategy. And then we have a combo that's going to take all 3 of those and hybrid them together. You're going to have big bet on tech, big bet on global equities. You're going to have all the commodity inflationary hedges, plus a big fat Bitcoin position called the Bootcamp Core, up 2% in November. So we'll discuss all of that and more in a moment. Let's look at the big picture of what's happening in markets and what our main projections is leading into Christmas. So the seasonality is for the market to melt up. You've got stock buybacks scheduled to the tune of $1 trillion, just massive amounts of money flowing into equities. And they don't really have a good alternative. The interest rate on bonds are extremely negative relative to inflation, and governments globally are trapped to expanding debt and devaluing their currency. So our projections have been very straightforward and very stubborn to make any changes. We believe there's a market melt up dead ahead. And the main catalyst that we're watching is that there's potentially trillions in new stimulus that may soon pass. So this is known as the Build Back Better plan or the social spending plan. Now, it was interesting whether or not we'd be able to pass the infrastructure deal separately. But once we saw the Democrats lose the governor race in Virginia, and I believe it was a top Senate seat to a truck driver in New Jersey, we predicted that this would get things rolling along. And it was the week after that massive upset that did light a fire under their ass. They passed the infrastructure deal. And so now they're pushing towards the Build Back Better plan. Also, it's important, the Biden-Kamala Harris polls are at record lows. They're in a total panic. They realize this is the critical moment to pass these pieces of legislature before the midterms next year. So last chance to pass spending before midterm. You don't want to be on the wrong side of this trade. It's often a bad bet to believe politicians will fail to spend money. That's what they excel at. And I think it's highly unlikely that they don't pass these bills. Now, even if they don't, I would still say it's going to be a very short-term blip in passing spending. So right now we're issuing a red hot buy trade alert. Now, what would change my mind? What are our lines in the sand to go defensive from a technical standpoint, not looking at the fundamentals and trying to predict the future of the budget, which I believe is going to obviously make these technicals come into play. Well, first of all, Tesla is always a wild card. This is a very important stock in that it's 5% of the NASDAQ, 2% of the S&P 500, massive position in hedge funds globally, central banks globally, you name it. Everybody is oversubscribed to Tesla relative to its cash flows. They're literally valuing it at what it might achieve in a decade. So this is our top stock to watch, and we got Elon poking fun at the globalists and the Democrats. So Bernie Sanders was his target this weekend, threatening to sell more stock. good news on the Tesla is that he only sold a fraction of what he was planning to sell. Now it looks like he's going to come in with a secondary offering. So very fascinating. What did he do? He managed to drive in massive put options, shorting speculation, and now he's pulling away from that. And I'm imagining another short squeeze coming underway for Tesla. So just funny to watch that. Now, what would upset me in terms of Tesla and getting worried about systemic risk would be we're going to get a little bit of a warning if it goes below 1,000. That's one moving average. That's interesting. If it goes below 800, a lot more systemic selling, capitulation, and systemic risk. But the good news is it looks like he's done poking the bear and is going to do a secondary offering. So I think that's going to potentially create another melt up in Tesla. We will see. More important, in my opinion, for predicting a recession or a deflationary shock is looking at the price of oil and the largest US oil producer, so Exxon. If Exxon goes below 64, we will definitely pay attention to that. Currently trading at 65.31, up $1.40, 1.46. I believe we're going to see in this cycle Exxon break past 100, and that's when I'm going to likely start to close out profits on our long oil bet. Now, we're not betting on XOM. There's a far better ticker to do that, which has nearly doubled since we were giving this out just a month ago. It's pulled back a little bit. We'll take a look at that chart. All right, the only ticker that's past a technical level to become alarmed with is DXY. That's the dollar against the euro. The technical line to become concerned about is 94.50. We are way above that at 95.84. And it looks like primarily the currencies really driving that are the Turkish lira, of all things, having a complete meltdown, the South Korean won. Other than that, and the Japanese yen, other than that, most other currencies are holding their ground. Now, what's going to happen when we go past a $1.75 trillion stimulus and expand the debt ceiling? You think the dollar's going up or down? Okay, I think it's a pretty clear bet that the dollar's going to go down. So I'm not freaking out about that. With our bets on oil, emerging markets, and crypto, the second that dollar starts coming down, we're about to see some of the most unbelievable returns that we've had. So last October, we had some of our best, or not last, just last month, we had some of our best returns because the dollar was pulling back just a smidge. I'm expecting a massive move down in the dollar. And once it hits the 89 to 90 range on the DXY, that's when I'm going to start pulling some huge profits in our portfolio on the inflationary bets. Okay, what else should we be worried about? TLT going below 140 would be like a black hole suddenly emerging right next to all our financial assets. It will rip them apart, suck them all in, and create massive financial destruction. Okay, and that's the level we're worried about. TLT is nowhere near that, trading at 145.50 today. No reason to get worried about the bond market becoming so attractive it's going to create damage. Okay, oil, with the dollar going up, the oil keeps going up. That just shows you how strong this inflationary impulse is. I would need oil to go below 75 to get worried. It's at 81.71 on Brent oil. Okay, we've been hearing all this fear mongering about China, real estate markets collapsing, their credit impulse is falling. All hell is about to break loose because of China, and their currency remains very strong. We're looking for CNY to go above 6.6, showing they're devaluing their currency. And again, it's not, the CNY is remaining very strong, trading currently at 6.39. So there's really no reason to get all worried and upset. 90% of my job is to convince you guys to do nothing. Sit there, let the strategy, the macro play out, look into the future, and that's how we're rewarded. Okay, now at the end of this video, after covering charts, data, and the news, we will review our exact trading formula, which means exactly how much money to put into each ETF. Now, just real quick, if you are on a free trial and you do decide you like what we have to offer, I want you to know we have this really cool turnkey software that I've not seen in any other competitor's setup. And what it does is it allows you to punch in how much money you want to invest. It divides it by what we call the unit cost. Okay, so all of our members are following a very strict ratio of shares. So for the high risk portfolio, currently the unit cost is 4,255. It started off at 1,000, so you can just get a feel for how much money investors have made with this strategy. Every $1,000 is now worth 4,255. And because we all follow the exact same ratio of shares, guess what? We get the exact same return, good, bad, or ugly, at all points in time. So we have some trade alerts coming. I've been waiting to pull the trigger on it, but this is what you're going to gain access to in the membership area. Now, if I were to scroll up or down, you would see the other three strategies. Of course, you need to upgrade if you want to gain access to that. In general, I highly recommend investors put 80% of their capital behind our Ray Dalio or Warren Buffett strategy, and then 20% behind the high risk portfolio. That's a really good mix to have most of your money in the safer strategy and a good bet on the higher risk. Now, if you're a little bit younger and you have a better time horizon to really endure the volatility that markets can have, then you may consider doing the bootcamp core plus the bootcamp high risk, and you could look at a 80-20 or even a more aggressive 50-50 mix. And so again, the older you are and the less time you have, the more money I'd suggest you plop into the pro, which is the safest strategy. And the younger you are, you can work your way into the higher risk strategies because you have income, you can afford more volatility, and you can endure these periods of volatility that the markets can give us, even when we have the best view on the markets possible. Okay, so very good. Most likely, we're looking at a stock crypto commodity melt up. I believe this is going to fizzle out around April, and it's going to be fueled by more stimulus getting passed. If Biden's Build Back Better plan is blocked, the market could crash for 1 to 2 months max, and then you're going to have a huge, huge shit show, which I believe will get the Senate pushing this legislature through, because the bottom line is their jobs are on the line. Okay, if they let a debt ceiling crisis occur, if they let the government shut down, or if they let the fiscal cliff potentially create a recession leading into the midterms, it's not going to work. So highly unlikely this bill doesn't pass, even if it gets trimmed down. The very worst case I see is a 1 to 2 month drama, which would be a buy the dip opportunity. I'm getting ready to hedge us against that risk, but we got to realize Pelosi's saying they're going to vote probably Friday or Saturday at the House. So maybe we hedge up on Friday, and if we get a bad estimate of the cost from the CBO, and we get Manchin and Sinema really saying, no way, Jose, we get more defensive next week. That's what I'm looking at. Now, failure to pass the budget will result in another debt ceiling crisis by December 3rd, unless our buddy McConnell decides to, of course, throw the Democrats another bone, and that wouldn't surprise me either. So let's see how this all plays out. By being patient, we've been racking up nice returns and carefully monitoring the risks. Now, I believe we could see volatility begin to pick up by November 23rd if there's no progress from Manchin and Sinema. They're the two holding this up. Failure to close a deal in November could likely cause a stock crash in December, and our UVXY VIX position protects us against that with at least 1,000% potential return. Here's the return of UVXY last March, going up 1,100% in less than 4 weeks with a 30% decline in the market, which was a very rapid decline. Now, get this, the market could fall 40% from here and still be above the crash of March. So we could be at February prices on the S&P 500 with a 40% decline. I actually think UVXY could return over 2,000% in the right setup. So if we got 10 to 20% of our account in UVXY, we can still be long these inflationary bets and easily survive a short-term crisis this winter. So I've been very careful and reluctant to increase our UVXY position, but mark my words, we're getting ready to pull the trigger and hopefully we hit the jackpot. Now may be the best time ever to follow our high risk, high return and pro strategy. I love combining those two if you have a high net worth and are entering or in retirement. If you have a longer time horizon, then let's not be a wimp. Go to either the Safe Alpha or the Bootcamp Core and then combine that with the high risk. Either way, we're playing the market in both directions and you have nothing to be worried about. If there's any reason to get bearish, trust me, I have been bearish too often at a fault and have been able to catch every significant sell-off for our clients. And sometimes we've been bearish when we shouldn't have. Last time was during the election where I thought we might have a hiccup in the Senate of certifying the election. So here we are entering the winter once again. And if there's anybody that likes to get bearish, it's me. We're waiting for all the signals and fundamentals to line up. If you had to boil it down to one single indicator, watch the price of oil. Watch the price of oil. This is being pushed lower by governments globally because inflation is their worst nightmare. It means they have to tighten up their budgets. Governments hate to do that. Okay, that's how they remain in power, by giving out free money to everybody. So that's the worst thing possible, is to have to tighten up their budget. So if oil's not tanking, we know the economy is still heading in the right direction. My core prediction remains that we have a slow motion multi-year rotation out of growth, long duration assets, and into value. So we're talking about a sell-off in the bond market, a sell-off in tech stocks, potential volatility in crypto, and in general, a rotation into value, which we're going to say are commodities and the banks. Now, here's a good look at the trend of when you crash your economy and respond to it with increased deficit spending while suppressing yields on bonds via quantitative easing and dropping interest rates lower. XLE goes parabolic, like clockwork, every single time. So in the dot-com crash in 2001, a year after the dot-com burst, they tried to reduce the deficit and created a 2-year stock crash. They learned their lesson and went to dramatically increase deficit spending while suppressing yields on bonds. And boom, you get XLE going parabolic. Okay, interest rates rose the entire time until the housing market collapsed. The big banks had to get bailed out by the trillions. They got a pat on the back. We went to double the deficit. For the entire period, we had twice the deficit spending. We were doing QE all the way till Mr. Trump came on board. And what do you get? This massive melt up in the energy sector. And then we do what? A global lockdown. The response was unheard of. Rather than double the deficit spending like we had the last 2 cycles, we tripled it, literally tripled it. And they're going to have to keep this massive spending going really indefinitely to avoid crises. So we're expecting XLE to have probably a 5-year run up. There'll be periods of volatility. There will be head fakes where the Fed says they're going to fight inflation and hike rates and this and that. But the likelihood is that they're going to have very dovish policy Government's going to continue to spend lots of money it doesn't have, and this is the perfect setup for these energy companies. Now, when stimulus passes, I'm actually expecting to see foreign stock markets greatly outperform US markets. And that's where Pro is going to shine. It has a huge position in the ticker EDC, which I'm getting ready to double down on with a trade alert. That's 3 times the EEM ETF. And it's got a big bet on Europe with EFA times 2 via the ticker EFO. So those are leveraged ETFs, but they're playing the most liquid ETFs in the world. And when you combine those 3 tickers, UPRO, EDC, and EFO, you own just about every large corporation on the planet with a market cap of over $126 trillion. If you want to know where the super rich have their money parked, it's exactly how our Pro setup is positioned. And here's a look at the last time we did pass the stimulus. You can see exactly what I'm telling you. What happens when the US passes big spending? We ship all the money overseas to import goods and services. Okay, and that's what's going to weaken the dollar and send these foreign continents' stock markets rocketing higher. We also got to realize that China's been holding back on printing money because they've been getting so much from the United States, but they're getting ready to turn on the printing press themselves. So I actually think emerging markets could very well likely be your single best index for the next decade. And that's also Ray Dalio's pick. So we can see emerging markets outperformed by 50% and European markets by 30% during the initial phases of passing that stimulus. Now, I'm also going to expect interest rates to rise. And again, this growth to value rotation. Let's review what happened when interest rates went up. And the yellow, we have rates. The yellow line's going up. That means interest rates are going up. At first, in the candlestick, the NASDAQ QQQ, it didn't mind the rates going up. And we saw XLE, the energy sector, and the NASDAQ. So think of energy as value and NASDAQ as growth. They both went up together. But when the interest rates went up at too fast of an acceleration, the energy sector continued to go up, and we had the NASDAQ plus crypto take a nosedive. Now, the good news for crypto and the NASDAQ was that we were about to have lockdowns in Asia due to the sickness. We can't say the real word, but you know what I'm talking about. And we had a complete, utter failure to recover the economy. This is because people were still getting paid to stay at home. So my expectation is for the labor markets to begin recovering around March of this year, upcoming year, and that we're hopefully coming to the end of all this lockdown and medicine mandates. So we'll see how much of a drag these mandates, the sickness, and the medicine will actually be on the economy. But that's what we're going to really get worried about, our interest rates rising and creating volatility in growth assets. So again, we've got you covered. As long as you follow the plan and don't cherry pick positions, you're really ready for any condition to come at you. Okay, so that's the 10,000-foot overview. If you're on a free trial and you want to gain access to that membership area, highly recommend it. The high risk strategy, we give you for free for two weeks. If you got a lot of money, you're silly to go all in on the high risk. Put the majority in the Pro or Safe Alpha, which is Ray Dalio or Buffett methodology, and put 10 to 20% in the high risk. You're going to do really, really well over the course of time. Call Dean now at 505-322-7515. Okay, very good. Let's jump into some data. All right, so first of all, this is what's upsetting markets and currencies. Okay, the US bond market on the short duration, so we're talking mainly that 2 years or less, has been going up rapidly. And this is suggesting that the Fed needs to hike interest rates. And now the bond market is predicting that by July, the Fed will be forced to start hiking interest rates to fight inflation. Okay, so that's earlier than I believe it will actually happen. And so that's exactly what's creating this volatility in the currency markets. We'll take a look at this in more detail, but this is very critical to predict. Okay, this is very, very critical to predict when we're going to go into a rate hike cycle, and what the impact of that will be on various markets. In general, it's not good for inflation. This will kill the inflation quickly and probably create a crisis in equities, commodities, and cryptocurrencies the higher these interest rates go. So it'll be short term. It'll be very short term, and they'll have to drop these rates right back down. When they do start to do this, it's going to be a massive money-making opportunity. So rather than get upset or worried about it, get excited. The sooner they do this, the sooner we can change course on our end. Now, if we go all the way to February, we can see the market's got a decent probability of rates getting hiked 3 times by February. That will do the trick. Okay, 1 rate hike, probably not. 2, maybe not. 3 or 4 for sure. You're going to crash everything, which is good because we know to short the market and buy the dip, expecting that there's going to be, guess what, more spending, more QE, rates back to 0, and bond yields entering a new bull market. Okay, let's look at the yield curve. In the yield curve, we're looking at, in the green color, January rates, in the black color, March, and blue are current. So what the hell is a yield curve? Good question. On the x-axis, so going from left to right, we have the duration of the debt instrument. I'll see if I get a little closer without it disappearing. There you go, very good. Okay, so the further to the right, the longer we're going to lend the government money. The further to the left, the shorter the period. In general, we want it to slope up like a ramp. Okay, and unfortunately, that's really not happening. Now, in January, we had that, but look what happened in March. The rates on the long end specifically began to leap higher. Okay, and that's exactly when you saw your tech stocks and your crypto get whacked in the head and pull back. Now, luckily for people who are long those assets, those rates came right back down. The labor recovery was dead. People were not going back to work because of all the free money the government was handing out. We had lockdowns spreading throughout Asia and Europe, and then we had a lack of stimulus. Okay, but what are we about to approach? I believe we're about to approach a big wave of stimulus, and hopefully the end of lockdowns and a very aggressive labor market recovery into next year. So I do believe these rates are going to rise, and that's going to be the most important risk to markets for the next several years. Now, interesting, the 20-year interest rate is higher than the 30-year. That's what we call an inverted yield curve. Usually, people get much more worried when the 2 and 10 or the 5 and 20 or the 5 and 10 become inverted. The most prominent move we can observe in this current example is that the 2-year interest rate has gone skyrocketing higher. So, and then meanwhile, the long end has fallen. So the market's saying there's too much inflation, we need to hike interest rates, and it's going to crash the stock market. That's my read on how to look at the yield curve right now. So the Fed's really trapped. If they don't hike rates, inflation's going to keep ripping through the economy. If they do go into a rate hike cycle, likely to crash the economy. All right, next thing we like to observe is the VIX futures term structure. We're interested in where the dots are jumping the most. Right now it's from November to December by far, and then from December to January. After that, the dots jump far less. This is signifying where the market's hedging and worried about volatility in the US equity market, specifically the S&P 500 or the SPY ETF. So clearly the risk is from now till January that there's a debt ceiling crisis if we don't increase that limit and pass this budget. So will the Democrats fail to extend the debt ceiling and pass their budget? I don't think they will, but we're watching this very, very carefully. All right, another way to predict volatility is the reverse repo operations. This is bullish. The more money that banks are borrowing from the Fed signals that there's high demand for US debt. Now, they primarily are interested in short duration debt to service deposits in banks. This is telling us there's a ton of money sitting in the bank. The banks are desperate for US debt products, and the risk of interest rates spiraling out of control right now are very low. So this is good news if you're still betting big on the NASDAQ, cryptocurrencies specifically. So those are the two assets I would expect to see volatility if this were to begin to fall. Now, line in the sand here would be $1 trillion, would definitely catch my eye. 750 billion, I'd start moving money out of assets that are at risk to interest rates rising. So far, no reason to freak out about that. Okay, so what's happening with rates, growth, and value in the short term? So we can see over the summer where I underperformed and did not anticipate all the problems with lockdowns. I actually thought the medicine worked a good bit better than it really does, which caught me off guard. This became evident in Israel in July, August. And now I'm highly confident that unfortunately the medicine is nowhere near as useful as we were hoping it would be. So this does indeed have implications on how fast we can recover the economy. In general, it's going to slow it down and keep all our inflationary bets intact for much longer. It's also going to give us a longer time horizon to be long assets like the NASDAQ and crypto. So we can see over the summer rates fell, energy fell, tech stocks went up. As we now approach the new debt ceiling crisis and the moment in time where we potentially increase the debt ceiling and pass new spending, the market's starting to bid these rates up, energy's front running this move, and the tech stocks are starting to stall out. So my bet is they pass the bill and NRGU breaks into new highs. All right, what are we looking at in this chart? The Russell 2000, ticker IWM, and the SPY. Now, the Russell 2000 was trading flat all frickin' year and finally broke out. This is signaling the market's ready to rip higher as soon as we increase that debt ceiling and get through this budget problem. Emerging markets been having a bad year so far. From February, where it was dominating, it's just sold off all year. This has been for numerous reasons. Slow uptake of the medicine, perhaps self-inflicted lockdowns throughout Asia, definitely slowing everything down. More importantly, we've seen China whacking different industries in the cause of trying to have a more fair economy for the total population. So they've humiliated people like Jack Ma, broke up his companies, outlawed video games for children, outlawed private education. They've been doing all sorts of crazy things, allowing real estate property companies to fail, to stop paying bond debt payments. They've been popping bubbles, essentially, at the cost of foreign investors, and trillions have been wiped out. Looks like they're getting ready to stop this policy as the US slows down its money printing. And that's what we tend to see, is these big continents take turns printing to keep the whole thing running. So I expect emerging markets getting ready to rip higher and outperform other indexes. Now, if interest rates rise, the European index is well suited for this with lots of banks. And you can see just how well EFO has been doing. I believe it will break into new highs as well. And again, we're playing that in pro with EFA. All right, here we're looking at 2 Grayscale Trusts. This is a big position in Bootcamp Core with GBTC, the Bitcoin, and in the high risk Bootcamp strategy, ETHE, Ethereum. So Bitcoin has limited viability in terms of being able to create applications and growth via technology. It's really just trying to be a currency. And in that regard, it probably has the strongest network by far, and it has the most deflationary monetary system. So until we mint all those 21 million Bitcoins, the outlook for Bitcoin is really marvelous. I do think Bitcoin will go up significantly. The bet with Ethereum is that it's going to do a whole lot more than Bitcoin. Now, while it does burn some of its currency, not enough. It's inflationary, has no limit. It's switching to proof of stake, which may be a weaker security system. The big bet for Ethereum is that it will become the Windows platform of blockchain technology and have lots of successful applications designed on it. But I'll tell you what, it costs a fortune to do anything on the Ethereum blockchain. Unless you're dealing with large amounts of money, it is completely outrageous how much money you're going to spend trying to do just about anything on that platform. And I know because I work with competitors, the Binance Smart Chain, Solana, Cardano, and Polkadot can do everything Ethereum can do at 1/100th the cost and much faster. So it's just outrageous how expensive these fees have become. With that said, Ethereum is getting ready to switch to proof of stake, and it could very well scream higher from here and punish its competitors once it finally makes that move. So all eyes on Ethereum. It could very well become the largest market cap. It needs to create a lot of successful applications. Right now, the only one that really stands out is Uniswap. Think of Coinbase, but decentralized. That's what Uniswap is. It's one of the largest market caps in the cryptocurrency space. So those are our 2 bets for Portfolio Builder. Now, if you do want a more aggressive portfolio in crypto, if you're a Portfolio Builder member, you qualify to be part of our private equity offering with Rebel Dividends. And we will definitely reach out to you about that opportunity because there's a handful of other competitors that I think you should have exposure to in case they take over some of Ethereum's market cap. Now, since October, our gold and silver play has been doing really well. So AGQ is 2 times silver, UGL is 2 times gold. Some of the big banks are predicting new highs for this sector. Perhaps these are the most undervalued metals in the world. And nice return since October, but boy, if we scroll back a bit, it's been a nightmare since really the start of the year. Now, last year we did hit a jackpot on our gold position, and we're fortunate to get out. We've had a small position in Safe Alpha with UGL and an even smaller position with Pro. So we got to wonder, is the time to bet bigger on this now? I think it has to be very clear that we're going to fail to recover labor and let these interest rates have a shock moving higher before I would get too bullish on gold and silver. So I think it's too early to bet the farm on these positions. We have a small position in the Ray Dalio in silver and the Buffett with gold. I'm not ready to get too aggressive on these positions currently. I think you're going to see better return in your NRGU oil play. All right, so what do we like if there's a crash? We like UVXY the most. We like TMF, that's 3 times the long end of the bond market, treasuries. And if we just need a safe place, if we don't think there's going to be a fast, violent crash, or we don't think bonds are going to go up, then we got to go to the dollar. But again, I don't want to bet against Democrats passing spending until it's very, very clear they're really stuck. So we've been not doing that. It's been the right call. I'll most likely increase your UVXY position Friday. We'll see if I believe they will pass it in the House on Saturday. And then we'll see what kind of squabbling we get in the Senate next week from Manchin and Sinema. So we'll see how that plays out. But these are the three tickers that would likely go up in a crisis that we're expecting. All right, now Boot Camp Core has a large position in FNGU. That's just been rocketing up 54% over the last 2 months. That's with Tesla getting whacked in the head. So FNGU is going to give you 10 massive US tech giants that dominate the returns, plus 2 massive Chinese, which are Alibaba and Baidu. I'd rather have Tencent, but hey, it's still a good setup. It's equal weight in 12 companies. So you get 8% in all 12 companies, and it's as aggressive as you could possibly dream of in betting on tech stocks. It's outperformed the triple Q significantly because of that. And this is because we see so much money concentrated into short-term call options on a handful of stocks, namely, mostly just Tesla. So you got huge exposure to that with FNGU times 3. So it's like having a 24% position in 12 giant tech companies once you understand the leverage behind it. Next play is solar panel. Love the solar play with Democrats in control. If we're about to have a meltdown in the midterms next year, we may call a top in TAN at some point towards the end of next year. Maybe the same for uranium. The only way we get to this carbon neutrality by 2050 is with nuclear. So if we really think the climate change agenda is going to be dominating, that globalists will control governments and not populists, we love the uranium play. Not in it right now, getting ready to buy the dip that we're getting on that for Boot Camp Core. Rare earth metals, I'm bullish on, regardless of globalists or populists dominating. That's your exposure to lithium and cobalt. Tesla and Apple alone need something like 30 times the amount we're creating over the next few years. That one's almost certain to go parabolic unless something disastrous happens to the world that crushes the global economy. And we can see some other little plays. KRBN is a carbon credit ETF. We haven't played. It's not on any of our tickers. I've just put it on there on a watch list. I want to get us back into copper. We need a lot more copper regardless of which type of political power we have globally. So those are some of our aggressive plays in Boot Camp Core. Okay, now I added some more tickers to the DXY chart. Usually we're just looking at DXY. I wanted to figure out what the hell's going on because the yuan in China wasn't going up relative to the dollar. Our main trading partners, Mexico and Canada, their currencies have actually become stronger against the dollar. The Brazilian real is not devaluing against the dollar. So where's all this pain? The Mexican peso is a little bit devaluing against us, not a lot. And it looks like pretty much it's the Turkish lira is causing all this. And boy, oh boy, they're constantly having all sorts of problems. And the Japanese yen. Now, Japan stopped printing so much money. It's really funny to see the countries that are slowing down their money printing and raising rates are having weaker currencies, and the countries that are printing rapidly have been able to keep their currency strong. So fascinating to see that. But there we go. That's where we can see the potential cause of DXY going up. At this point, I don't think we should make too much of it to change course. Okay, here's that Chinese yuan, CNY. Again, just ultra strong. Now, if this is going up, it's weakening. If it's going down, it's strengthening. So in general, no reason to freak out. Here's a look at NRGU. It's a roller coaster, and I believe it's going to go much, much, much higher. Not just a little bit, Okay, a lot. Now, a lot of people want to say, oh, it's a triple top or a head and shoulders or who knows what sort of voodoo magic technical analysis. Don't look at leveraged ETFs with technical analysis. Okay, let's look at what we're actually playing. Okay, we're playing ExxonMobil. The projected profits of the oil and gas sector are going to hit record highs and they're never going to look back. Okay, so unless something devastating happens to the economy, I am extremely certain with the way the political powers are making it very hard for anyone else to get into oil. It's really the big dogs have complete supply for the US. As the price of oil goes up, their profit margins are going to be outrageous. The demand for oil is going to grow. There's absolutely no threat that any other energy source is going to be a problem for oil anytime soon. So wait for the dollar to hit 90 or 89 or watch ExxonMobil get above 90 before we get worried about this position. We're nowhere near either benchmark to become bearish on the energy sector. Okay, this is where we compare interest rates to oil. And the lesson here is that the interest rates follow the price of oil. And so I believe interest rates are going up significantly. And again, that's outside some sort of devastating effect to the economy, which I don't see playing out. A lockdown in the US would do the trick. We had Austria do a lockdown on the non-medicine folks. We got Germany talking about lockdowns. Lots of talk. I don't think there's a political willpower in the US. Okay, so unless the US is going to lock down, I don't think we're going to see a big sell-off in oil. And even if we lock down, it's for a very short period of time and then all that demand comes right back. So it's going to be very, very, very difficult for me to tell you to exit NRGU. Anita says, why didn't we take profits? Because we're about to make a lot more money, Anita. We're not going to be a wimp. And yeah, we just don't want to be a wimp when we're about to see NRGU double or triple before we sell. Peanuts. We've made peanuts on that play so far. Okay, here's another important metal to follow, copper. Gold to copper ratio is highly predictive of interest rates. It's trading flat, probably about to leap higher. China's having a very slow down period that's probably about to ramp up. Lumber futures and natural gas had a little pullback, again, still at extremely elevated levels. What we're predicting this winter is one of the coldest winters in history, and there's a massive shortage of the energy products we need. So this could be a heck of a melt up coming in the very near future. Boyle is a ticker we could use for natural gas that I'm considering playing short term, but it's the same idea as NRGU, so I'm not so sure we'll pull that. Okay, Baltic Dry Index has crashed 50%, showing a slowdown in the demand for shipping all these commodities around. That's what the Baltic Dry Index measures, which is good because these were all getting outrageous. I believe it's going to stabilize here and trade at historically high levels. So we saw this with lumber futures. We're seeing various parts of the economy that get hot, getting hijacked and pushed to really elevated prices. They pull back, but then they still stay at historically high levels. So we can see even at this 50% crash, it's still well above the cost to ship these commodities that we've seen ever before in history. You'd have to go all the way back to 2009 and 2008. Oscar says, why are the cryptos selling off? No idea. You got to realize the market's very leveraged. So if somebody does a big sell order, creates a bunch of systemic selling, and then these whales come in and eat your lunch and buy the dip. So I think we should just anticipate constant volatility in crypto to be completely normal, because there's a lot of maniacs that like to go use 10 to 100 times leverage. So whenever they see an opportunity to go knock you out of your position and buy it up, they're going to do that. All right, so here's the big move in the bond market. 2 years up 146% since September, and really the move began right here. This is predicting rates go up. That's a big problem. Now the long end is saying not so much. That's not going to work. So very, very interesting developments in the bond market. A flattening of the yield curve. Gold copper ratio is trading flat, not giving us a signal up or down. I believe the next move is likely that the copper goes up on the catalyst of stimulus passing, the debt ceiling being increased, and that the risk period is between now and March. We'll talk more about what could happen with lockdowns between now and March. All right, here's the important rates markets that we can look at as a ticker, TLT, going up. Not a problem for us. That means rates are becoming more and more unattractive relative to inflation. LQD, J and K, that's how we fund all these corporations with unlimited money at super low rates. So if those are going flat or up, it means more easy money for corporations. What do they do with that money? They do stock buybacks. So no problems in the bond market. Now, Janet Yellen's moving her issuance to be heavy on the front end, which is what the banks are really requesting. A lot of short-term debt. They don't like the yield on the long term. They need short-term interest to pay deposits because they have more money parked in the bank than they've ever had in history. And so that's what we're seeing right here is they're issuing a lot of these short-term debt products, which we believe will be well received and not create problems in the equity markets. And that's because reverse repo is still at $1.4 trillion. There's just not enough. Now, here's some interesting data. Vermont, I think the second most medicined country, state in the US, medicine's not working. Cases are at record high. If we go to Germany, again, very strict mandates, very high acceptance of the medicine, and it's record high cases. I believe you could find the same thing in Singapore right now. We saw this in Israel over the summer. So what does this matter? Well, here is the rate of change of cases in the US, and I've been telling you that we should expect a slowdown into October, November, and that it would ramp up by the end of November and hit new records in December, January. Now, it may not be people who are testing positive for this specific sickness. I just, in general, believe we're going to see a lot of sick people overwhelming hospitals in December and January. And if the Democrats cannot pass their budgets, that they could use a health crisis scare to create lockdowns, create a stock crash, create a slowdown in this inflation, which the Republicans are just ramming up their butts in terms of trying to gain political support. Well, they could accomplish a lot with a lockdown. They could create the stock crash, they could kill off inflation, and they could help pressure the Senate into passing their budget. So if they don't get this deal through soon, I do not think that lockdowns are off the potential playbook for the Democrats to get their objectives. So we're seeing it happen in Europe already. All right, the jobs came in at 500,000. I think for rates to start moving higher, they got to start printing at 700,000 consistently. So to believe we're going to really spark a sell-off in tech stocks, watch for non-farm payrolls to start clipping at above 700,000. And so far, we've had that occur 3 months out of the last 12. That's why you're not seeing this growth to value rotation really take hold yet. And I don't think there's a significant risk of this occurring till March, April, May, June, July of next year. So we'll see how that plays out. Core inflation we predicted would jump this month. We predicted it would be flat or lower last month. And so far, we've been good at predicting this. This is going to pressure the Fed eventually to hike interest rates. But we know they probably won't do that until the labor market's strong, which means we need those 700,000 prints. All right, if rates go higher, banks are more interested in lending money. And there's an argument that interest rates rising could be very bullish for inflation. And so we're seeing it. Here's the banks starting to really throw out that money with bank credit rising. We're seeing consumers willing to borrow, keeping the retail sales red hot. So all the fear that the end of the free money would crash the economy is not coming true at all. Retail sales up 1.7. That was a new print this morning. The consumer, although slowing down, is still at record spending in all of history. Jobless claims, 267. It's headed the right way. I'd like to see this go below 200. The inflationary pressure from wages rising is well intact. We had month over month hourly earnings up 0.4% and wages year over year up 9.5. So a lot of pressure on the inflation side. Now the bond market's really going to get upset if the labor force participation rate rises. That's not happening. And it's not really happened a whole lot for several decades, which is why you've had this long-term bull market in bonds. The only time we've had bonds really get upset was when we did quantitative tightening, rose interest rates, and had labor force participation rate rising during the Trump era. Okay, outside of that, it's been a bloodbath. We've outsourced all the jobs to China, and this has been very bullish for the bond market, predicting low growth. So, can we get this up? And we got to realize the trajectory before the pandemic was this would be way up here. So to really recover the lost ground, labor force needs to skyrocket, and it's just trading flat. So not good in that front for labor recovery. Okay, balance of trade hit a new low. That means the dollar should go down if we throw in some deficit spending. Personal income actually came down a little bit. Some canaries in the coal mine to tell us to get up, to get worried would be Apple crashing, not happening. Tesla crashing, looks like that's potentially over, especially if Elon's going to do a secondary offering. So imagine all the people who went short getting squeezed out again. Not saying it's going to happen, but how funny would that be? And we had Michael Burry, who was trying to short this from here. The poor guy tried to short it at the very low and just got wrecked. ARK funds, another asset that could create systemic risk, just trading flat, nothing to get worried about there. Tencent, if Facebook doesn't own it, Tencent does as far as mobile applications go. Stabilizing, looking ready to rip higher. We have big exposure to that with EDC. Alibaba, Charlie Munger said he doubled down on their position, and it's gone up ever since that. So no pain there. We've got Samsung starting to stabilize here. This has been the most worrisome stock exposed to an EFO. And then Toyota hitting a new high. So there's really just not a lot of reason to think anything bad's about to happen in the very, very short term. China's PMI stabilizing. European PMI still in positive territory, although falling. We did get a bigger drop in Chinese imports, but in general, I am not worried about China. If we look at it historically, it's still above any level they've ever had in history, despite slowing down slightly. And US about to put the printing press back on with this big Build Back Better bill. Exports fell a tiny bit, nothing too crazy on that front. What's happening at central banks? Fresh high in the US central bank balance sheet, which has been highly correlated to stock valuations, and same thing in Europe. Okay, so even though they're tapering, they're still going to go up till next summer. Japan has slowed down. So again, where's that weak currency? The bank that stopped printing money. How funny is that? All right, let's look at our top news. Here's a look at the weakness in currencies. So we can see it's South America has a few, and then Turkey. So we got Turkey down 28%, Argentina down 16%, Chile, Colombia down 12%, all tiny economies. The most impactful is certainly the Japanese yen. And so that's where we're seeing the weakness. I just don't see any reason to get all excited about that in terms of changing the way we're playing the markets. Biden had a speech with President Xi of China last night. Supposedly went well. Next day, they're talking about boycotting the Beijing Olympics. Manu Raju, a CNN correspondent, says, I asked Manchin what the West Virginia voters are telling him about the 1.75 trillion Build Back Better bill after a week back home. He says his voters are very much concerned. Inflation has hit them extremely hard. I hear it when I go to the grocery store. They say, are you as mad as I am? And I say, absolutely. So that's not good news on that front. We'll see. The third biggest whale address adds 207 Bitcoins. So again, they like to see people get over leveraged, sell it off, capitulate, and accumulate. So nothing to get worried about on that front. Goldman Sachs forecasts S&P 500 will hit 5,100 by the end of next year. China sent 8 warplanes into Taiwan's air identification zone just hours after Xi and Biden's cozy virtual meeting. Peter Schiff says inflation's about to rip your face off. Just joking, but in general, that's what he has been saying for several months now. US retail sales increase. We just saw that chart. Did Biden ask Xi about the origination of the pandemic? No. I would say our government was in on it, unfortunately, which is why everybody just raises their hands and says, I don't know when it comes to that question. We're seeing inflation start to pick up globally across the board in this chart. And then Biden and Pelosi and Jayapal are tweeting about every 3 to 4 hours about how great the Build Back Better deal is. They just signed the infrastructure deal. That doesn't have a huge impact on the economy because it's only about 55 billion a year for 10 years. So not a big, what we're interested in is expanding the deficit. That's what really makes all of our bets in the market play out. Pelosi told her colleagues the House isn't leaving for Thanksgiving until the Build Back Better is passed. According to two sources familiar with the matter, there's a potential Saturday vote, but it could happen sooner than that, depending on the timing of information from the CBO. So they are trying to, I guess they're already saying the bill is not paid for. You're going to have to raise more taxes or debt to pay for it, which is what supposedly Manchin's against. So we'll see how this all plays out. It seems young athletic males are really at risk of problems with their heart from that medicine. That's becoming very clear. 60 times increase in serious events. Elon Musk, so maker taker in the bid and ask on crypto. So he's joking that Bernie's a taker, not a maker. Always good fun following Elon Musk over the weekend. Again, I do think we're going to see overwhelmed hospitals despite the medicine. Unfortunately, will this create lockdowns? That's what we care about in terms of playing the markets. Okay, I think that really covers what's important on the headlines for today. So all eyes on that budget. We need to just be patient, see how that plays out. And again, the DXY, we understand. We've got the Turkish lira just completely crashing and the Japanese yen being weak, plus the South Korean won. But that's not enough to think there's problems for global equities at this point. Okay, very good. So I'm going to go back to the transition slides before we go into asset allocation. Now, if you're on if your free trial has ended rather, and you're catching this replay, this is where your video ends. You're not a paid member. You need to call Dean to upgrade, gain access to all the advisories, the membership area, and more importantly, the trade alert that's about to be issued. You do not want to miss that. Call Dean now, 505-322-7515 to upgrade. Okay, great. So I'm going to close out the version of the video that some people get access to that have not paid as we enter into the part that's for paid members only.